I just want to construct a bearish trend first here. Yeah, I'm gonna construct a bearish trend so that we can get to understand. I'm just trying to construct a bearish trend.
Okay.
Yeah, this is what I'm doing. So it's easy for for someone to understand. This is a bullish trend, a bearish to bullish. You could see. Okay, I'm trying to. Okay, what I'm trying to actually to explain here is the meaning of a choke, and you already know a choke. It means the change of character.
Yes.
Change of character, it means the trend changing direction, either from bearish to bullish, or from bullish to bearish. You know that, right?
Yes.
So here, we're changing from, where?
Bearish to bullish.
To bullish. And I say on a bearish trend, you have to know the futures of a bearish trend. When the trend is selling, the trend keeps on making the what? Series of what?
Lower high and lower low.
Lower high, and the lower highs are meant to be the strongest swings, which keep pushing price down, breaking the what? Taking out the what?
Lower low.
Yes. Taking out the lower low. Right? Wherever the lower lows get taken out, what do we form? Which swing do we form? What is this swing that we happen to form?
The swing low.
I want the name. How do you mark it?
How do you mark what?
This swing. If the lower low happens to break the previous, if the lower high happens to break structure, taking out liquidity resting on the lower low, what is the immediate swing which is formed down here?
It's the lower low.
It's a new lower low.
Yes.
Meaning wherever we experience a break of structure, this was a break of structure. Wherever we experience a break of structure, we hoping for price to do what? Before we continue to sell, we hoping for price to do what?
To take out the lower low.
We hoping for price to retrace fast. Break and
then breaks below the lower high.
Yeah, that's with break and retrace in price action. In ICT, we hoping for price to do what? To mitigate back. And where is price mitigating back? Price is retracing back to areas of premium. All this area of premium are the areas above the equilibrium. Equilibrium, on a Fibonacci is 50.0, right? So wherever we on a bearish trend, we keep selling in areas of premium. We call them the areas of premium. If we bearish, we keep selling. It's the opposite of a bullish trend. We keep buying in areas of what? Discount. Below the what? The equilibrium. Only that I don't have sorry?
No, I was saying the 50% it is when the trend is bearish.
It's in the middle. The trend is not decided 50%. That's what we call it, the equilibrium. Means buyers and sellers are not decided. have equal power. If you see the price in the middle around 50.0, buyers and sellers are equal.
Okay.
You don't do anything, but the retail traders happen to buy to take trades from there. As we don't do
Okay.
that, ICT traders, they don't do that. ICT traders always take trades below that 50 or above that 50, depending on the direction of the trend, the readings of the Fibonacci. So I just wanted you just to understand the swings of the bearish trend. So we're marking them. How do you call this swing? I just want to finish marking them. This is what?
A lower high.
Lower high. And this?
Lower low.
Okay. And this?
That is the lower high.
And this?
Actually, now the trend is changing.
This is the lower
so that
low.
can also be a higher
bearish.
high.
We're still bearish. We haven't confirmed to bullish. This is the lower low.
Okay.
What is this now? We're taking out a swing which we're not supposed to take out. We're violating now the trend. We're violating now the lower highs. The moment you happen to see price violating the lower high, of which you know that it's the one which keep pushing the trend down, the time you see price violating, taking out the lower high, is the time now you notice that the trend has an intent to change. Hello? Yes.
Yeah, I'm here.
So we can see our first break of structure when our first break of structure in the opposite side of the trend, when we happen to take out the previous lower high. And our first break of structure is what we call a what?
It's a higher high.
Okay, it's the higher high. This is the higher high swing. And our first break of structure, we call it a what?
Change of character.
A choke. This is what you call a choke now. You've confirmed the intent of the trend to change from bearish to what?
To bullish.
By seeing price doing what?
Exceeding the lower high.
Lower high, creating a choke and also creating the first confirmation of a higher high. A higher high, this is one of the futures we see on a bullish trend. You never see a higher high on the bearish trend. So this is the first confirmation, the choke and the higher high. Once you see the higher high being created, you definitely know these are one of the swings of the bearish trend, of a bullish trend. And you know, wherever there is any kind of break of structure, what happens to price? How can price react? Wherever there is a break of structure, what can we expect price to react?
It will retrace.
It will trace, exactly. So this is the retracement. And wherever price retraces, as we're looking to buy within the areas of what? We're
of discount?
Yes, of discount. Areas of discount are literally below equilibrium. So that's why we have to go back to our chart. We look at the same thing that I've been trying to explain.
Okay.
So I'm deleting this, showing you that we happen to violate the what? What did we violate here? This is the what?
That is the lower high.
This is the lower high. So we happen to violate it, creating our first break of structure in the opposite direction of the trend. Remember, we've been bearish. Now we're breaking in the opposite direction. So this is what we call our what?
Change of character.
This is our change of
Choke.
character. Yes. And you know, wherever the trend breaks structure, this is our expansion leg which broke structure. What are we expecting?
We're expecting the price to retract.
Exactly, to retrace. And in which areas are we expecting price to retrace to?
Below, from between 50 and 100.
Exactly. So between 50 and 100, you see how many order blocks do you see? Because the bullish order block, if we're buying, wherever we're buying, we have to buy on a red candle. That's what we call the bullish order block. How many of them do you see below between 50 and 100?
The bearish candles, I can only see 2.
No, there is one. We're marking the expansion swing only. There's this one, only one.
Okay, yeah, it is one.
It's only one within the
Okay.
expansion. So this is where we're expecting price to drop.
Mm-hmm.
It's easy to even tell where price might drop. This is where we expect price to drop. Sometimes price might not drop exactly at this order block. It might even come and respect this area of what? 61.8. It's still the area of discount. It's still under discount. Even 50, since it's the beginning of discount, it can respect 50. So most of the time we have to wait for price to react at this area of the order block. That's where now we'll be looking to do what? To buy.
To buy.
We always buy in the direction of the what? Of the trend. Since it gave us the anticipation to buy, it's changed. We always have to wait to buy within demand. This is the demand area now, the order block. Yes. So hope now you're managing to understand the meaning of a choke.
Yes.
So now we're gonna be able to practice more so that we can tell how we can be able to make our break of market structure in the ICT. So I'm gonna go to actually a bullish trend. And I'll be using let me see, I'm looking for a bullish trend. Let me use oil. Because now we're gonna start marking from the choke, and we have to be able to mark all the break of structure, the bullish break of structures. That's what we're looking. Because you talked about you just wanted to know how do we happen to find a choke, and how do we happen to be able to mark our break of structure, isn't it?
Yes, and then from there we make the entries.
Yes. Yeah, I'm gonna delete all this. This is oil. Let me use 1 hour. Where do you see our choke? Because this trend was bearish, as you see. Let's even see. Yeah, this trend was bearish previously. Can you be able to tell where we violated the previous lower high?
Yeah, there where it is formed.
We violated the previous lower high.
Where your cursor is right now.
Yeah, because yes. I'll be marking the lower highs only for now. Lower highs, so that you know which lower highs did we violate. I'm marking the lower highs of a previous bearish trend. You know, lower highs are meant to be the strongest swings on a bearish trend. And they're the ones responsible to keep pushing price down, breaking below the lower lows. So where did you see price violate? Which area did you see? Which lower low was violated?
The last one at the bottom.
You always have to mark it with a trend line. So definitely this is your choke. It's always easy. You see? And wherever we experience a break of structure, you know, we always have an expansion leg. You see?
Yes.
But most of the time, after we experience a break of structure, we see our chalk. Always wait for price to come back within areas of what?
Discount.
And areas of discount are which one?
Between 50 and 100.
Okay, between 50 and 100. Where, how many order blocks do you see? How many red candles do you see?
Between 50 and there's only one which is
One
sitting
here.
Yes.
Do you see that
that's
price
the one.
bought at the same order block that you see?
Yes, it
So
did
we
respect that, yeah.
bought there. Do you see how easy it is?
Meaning you have to wait and wait and wait up until it respects.
It's up to you. It's up to you. If you want to trade the
that
retracement, you
range
can
of
trade the
50 and 100
retracement.
before you can place your.
Exactly, but it's up to you if you want to be able to trade the all moves, the retracement and expansion. But the principle of safe trading, you always trade following the direction of the main trend.
Yeah, because otherwise you'll be trapped if you're trying to chase the trend or ride the trend.
So now here we came to break structure. This is our actually it was our first break of structure, the time we started buying. So wherever price breaks above the previous higher high, so this was our previous higher high, because we are on the bullish trend. Bullish trend, we keep forming series of higher highs and higher low. Now this is the higher low that you see.
Isn't that our break of structure where there is that void? That is where our first break of structure, or that is the internal?
Yeah, this is the internal. You always have to make the external.
Oh, okay.
Yes, we always have to make the external.
Okay.
Yeah, because after we saw our first break of structure, this was our expansion leg. You see it?
Yes.
And wherever price breaks structure, you know, it has to do what?
Retrace.
Exactly, retrace. So most of the time, when you put your Fibonacci, it won't come back to the area of discount. Wherever the principle say, wherever you fail to see price failing to come back to the area of discount, where you have to mark, where you have to enter, you know, the area of discount are between which one? Which zones?
1500.
Wherever you fail to see, here price fail to come to the area of what?
Discount.
There is no entry. Here you don't see the entry, meaning you haven't got an entry. Either you wait, you check other pairs that you're trading, so that if you fail to see an entry, don't chase after price. That's how we were taught. Wherever you see price failing to tap 50, because we can only buy at 50. If it manages to tap at 50, we can be able to mark the order block within 50. We can possibly buy at 50. But if it fails to tap 50 or below, then there will be no entry. You let the trade
must
go.
stay away.
Yes. We always respect the areas where we buy and sell from. So it's clear for you now for a bullish trend. You keep marking the break of structure wherever you see structure getting broken. And you keep still following the same concept. Break and retracement.
Yeah,
break
and then I can see now.
Retracement. Where do you think we can possibly buy from? This is our Fibonacci. Let's up.
Wait. Just go to the last one. You see now we are on the second break of structure, right?
Yes. This is our second break of structure.
Yes. Can you just go drag the Fibonacci and it put it whereby you have got the higher high there. It will give us a nice entry, I think.
This
Not
is
so.
the higher high, and I'm connecting the higher low to the higher high. The Fibonacci has to sit on those two swings. This is the higher low and the higher high. This is where I've placed the Fibonacci.
Okay, but can you just maybe drag it back on the previous one? I think there's an entry there. I don't know if maybe
Okay, let me try and follow what you're trying to say. I'm dragging it back. Yes. So what are you trying to say?
No, it won't fit. You see where there's a where there is a void.
The void, yes. Like
Yes.
the void was filled.
Isn't
Yeah.
that
this is the void, yes.
yes?
Where there is this void.
Can't we say that this is a higher high and higher low?
Exactly. But I just wanted to first show you the whole concept of break of market structure,
okay.
and how you are able to place the Fibonacci. That's what I wanted to show you first.
Okay.
But honestly, price is likely to come, fill the void before it even thinks of continuing. I'm thinking of this void first to be filled.
Okay.
Yes. And I'll see that on 4 hour. Because on 4 hour, this will be my what? My expansion. Yes. And the void, this will be my retracement. And this will be my order block on 4 hour. Yes.
Okay.
Let me see what's happening. It's like the network. Okay. Because I can't see my charts now. Yeah. So you see on 4 hour. On 4 hour is different because I like 4 hour. It gives more sense.
Okay.
Because my expansion leg will be from low to high, and my void will price. It shows me price has to fill up the void. Of which, if you go to 1 hour, 1 hour we have two breaks of structure, as you see. Someone might get confused because this is our first expansion on 1 hour, and this is our second expansion. That's why we have to break off structures. So if you are to place a Fibonacci, you can still press it on the last break of structure, and you can still press it on the what? On the first break of structure. So the only thing, wherever you're doing ICT, we follow a lot about liquidity. So this is liquidity. This is the liquidity area. We trade, we mark order blocks. Okay. Which are below the liquidity area. So this is the liquidity area, the void. This void you see. You can even see the equal lows here. Yes. This is liquidity area. The void has to be filled before anything happens. This is now the void from this week to this week, this FVG. So price automatically has to be attracted to that FVG, fill it before it continues to buy. Yes, towards this order block that you see. Okay. Are you trying to get it? Wherever there's liquidity, price always fills it up, clears it up before continuing. There are low chances of price buying from here without filling the liquidity first. There are always low chances. So I would expect price to first come and tap this order block, this deep discount area before buying. Yes, so this is my all setup. I'm concerned about these liquidity areas, the equal lows and the FVG of the order block. And also the trend line liquidity. But you haven't started more about it. We also have the trend line liquidity, this one. It has to be taken out.
Sorry, what did you say that it is a trend line?
Trend line
Liquidity.
liquidity. Yes, this is what we call the internal range liquidity. Trend line
Okay.
liquidity. You just draw a trend line. As time goes by, you understand all these concepts because we have
Okay.
lots of categories of liquidity in ICT.
Okay.
Yes. So can we look
so
at another? Sorry?
Oh, sorry. No, I was saying the liquidity is not only in a straight line, like the equal law that I've shown there. We can see that there is a liquidity there. But now with a trend, I can see that something was building up there. Yes, I get it.
You get it.
Yes.
Does the lesson make some sense to you?
Yes, it does make sense.
Okay, which last pair should we look at?
Okay, but just in conclusion for this one.
Yes.
So now this pair, it is now reaching its maximum. If we can put an order block there.
Okay, because the order block is always the last what? An order block in simple terms. Wherever we're buying, are you still there?
Yes, I'm here.
Wherever we're buying, we always focus in areas where price is discounted.
Okay.
And we always look for order blocks below the discounted areas. Like on 4 hour, it's clear. If we happen now for an expansion leg to complete, we shall stretch our Fibonacci, for example, here to here. You basically see where our discounted price is. Even if you have 2 order blocks, price you always have to wait to see which order block, even if they are 2 in areas of discounted, price can literally choose only one order block to buy from. Okay. You can only see it with the confirmation in the lower time frame.
Okay.
Yeah, because we confirm all our entries in the lower time frame, 5 minutes or 15 minutes. So if maybe you happen to see price tomorrow here, so that's when maybe you're gonna look at we're gonna now figure out how we could be able to confirm our buying entry. But we have to be patient enough, wait price to do what? To retrace to areas of what? Discount, feeding, taking out these equal lows and filling up the void. This is the imbalance.
Okay.
Yes. Yeah. In actual sense, this FVG attract price most of the time. And sometimes price can come and respect 50% of the area of the FVG, of this gap. Most of the time, the gap are used also for entries. Price would fail to come and tap the order block, but it will respect this 50%. Let's say from here to here, in the middle of the FVG, price always do that. So you can take entries on the order block or entries at the equilibrium. That's 50% of the FVG. Those are the options of entries.
Okay.
Yes, but this needs a lot of practice, Baba, a lot of lesson. You need to actually study the whole lesson of order block trading so that you can get used to all the types of liquidity that we look at. Because we have a lot of liquidity. Yes, we have lots of liquidity pools. We trade the equal lows, equal highs. We trade the volume imbalances, that's the FVG. We trade the trend line liquidity. Time is up. Time is up, but hey, actually we're having 10 minutes left.
Okay.
10 minutes left. I would advise you, Dr. T, so that you can take full courses, not partials, if you really want to understand the whole scenario of ICT, because this will confuse you a lot if you don't know where actually you need the basics, the first basics, the whole topic to cover actually everything. Because the topic of liquidity is too wide, you need to understand liquidity. Actually, it's the best trading methodology so far.
Okay.
Yes. So we've looked at a few things. At least you understood the way ICT traders trade compared to the retail traders.
Mm-hmm.
Yes, and you've seen the way the Fibonacci is used for ICT traders. It's different from the way retail traders use it.
Yes.
Because ICT
for the retail,
sorry?
sorry. No, I was saying because for the retail traders, normally when the price reaches 50, that is where normally they make their entries, yeah?
Yes. 50 or 61.8. But here in ICT institution, we focus on price coming to discount or premium. Those are the terms we use. When price is high, it's in premium. When price is definitely low, it's completely low, we call it discount. So that's when our buyers come in to buy a discount. Yeah. So for a retail trader, for him to buy at 50, it's like he's buying in the middle of undecided price. So which is a trap. He can easily be trapped by the smart money.
Yes.
So this ICT needs actually for you to take one course after the other. You study the order block trading methodology, you study supply and demand, and you have also to study what we call AMD. The daily candle is what? Accumulation, manipulation, and distribution. Yes. So those are the topics that we covered all, so that we able to tell. It's easy. You can easily tell the movement of price, the future move of the price. Depending on the AVG placement, the liquidity existence, you can simply tell. Yes. So I would recommend you to do ICT, I think, because you're already good at retail trading.
If I'm good, I was not gonna lose all my money. I'm joking. I can say theoretically, yes.
Patience only, my brother. We only lack patience. Yes. But
and also not knowing what to do, I think that is the problem, That is why I highlighted that the entries and so on.
No, and also
like
not failing to pay school fees also.
Pardon?
And also not wanting to pay school fees.
And also what?
Failing to pay school fees.
Fed.
The school fees.
Yeah, that's another problem.
Okay, we're ending the lesson here. Mr. T, you have a question before, because we are left with 4 minutes.
Yes, but quickly, if now we want to trade the retracement, I think now the price where it is right now, it is tapping on the order block. Can we maybe just draw an order block there?
Yeah, I'm drawing it. This is the order block.
Yes.
It's tapping.
Yes.
Yes.
If now we want to,
we go to
take
lower,
this down.
We go to lower time frame. On lower time frame, we have to expect price to give us a choke. We wait for the choke also. We have to look for a choke on 15 minutes. A choke, something like this. A choke. Something like a hem. When you see a choke, then you confirm it by you enter on the retracement. That's the confirmation entry. We also wait for the choke. We also wait for the choke, bruh, on 15 minutes time frame. Yes, we also have to wait for the choke in order to see that the price is reversing on 15 minutes. Then we again a retracement to form a lower high. We enter on the lower high to sell. And then also withdraw our Fibonacci there, if possible. If possible, yeah, you can draw your Fibonacci wherever you've seen the break of structure. Because Fibonacci, after there's a break of structure, that's a choke, you always have to draw a Fibonacci. Wherever there's a break of structure, yeah, it's valid for the Fib. Oh, okay. Yes, yes, bruh. So we're ending from here. Let me send you your video.
Yeah, if you can just send this, and then yeah, I will go through